Good morning, everyone, and thank you for joining us for this tax and regulatory seminar, which we have organized. And we were just expecting some more people to join in. So I think people are just joining in. So we just wait for a couple of more minutes. But thank you so much for joining us, and we'll be looking forward to our interaction during this webinar, which covers the tax and regulatory challenges and current updates which have taken place in the recent months. And please bear with us for a couple more minutes and as people just joining in. Good morning, everyone, and thank you very much for joining in for this tax and regulatory seminar which we've organized. What we've seen since the last year, the economic and financial world has seen significant disruption and impact due to COVID-19 pandemic, and which has resulted in huge changes to the way we live, work, and do business. This has presented government leaders, management, and staff of companies with unprecedented challenges to address liquidity issues, business disruption, frequent lockdowns, and the widespread health crisis which everybody had to grapple with. has had an impact, huge impact. The adverse impact has been felt across industries around the world, especially the airline industry, banking, tourism, hospitality, with the disruption of demand and supply chains. While many sectors have also benefited, like technology, which has been the savior for everyone, food delivery, logistics. So these are some of the sectors which have really benefited out of the impact. Governments, at the same time, had tried their best to mitigate the impact so that they can soften the adverse impact on people, businesses, and communities by offering bailout packages that reduces the cost of doing business, offering tax reliefs, deferment, and loan relaxations by banks, which has helped absorb the impact to a great extent. Focus has now shifted to a business rebound, which is basically driven through ensuring that a V-shaped recovery and sustainable recovery is made around the world by everyone concerned. Governments at their end have really speeded up the vaccination drive. Thousands and millions of people have already been vaccinated. This has really helped in improving the confidence business all around. And we've already seen some positive signs of recovery what we've seen is because of the early adoption of technology, process automation, digitization, and also the way we are working in terms of remote and flexible working environment, online education, and realigned supply chains, and also adopting more sustainable environment practices. So this has been the big positive trend what we've seen across geographies, and especially in the UAE and GCC as well. One of the main pressures which the governments have faced is to raise additional resources. All these costs, additional costs to provide relief to the communities and businesses, governments have had to look at various ways, revenues streams to increase selling of assets. They've also increased the VAT rates, for example, in KSA, where the VAT rate was increased from 5% to 15%, which is a significant development. And also, governments have tried to make sure that the economic and regulatory environment is also strengthened, which is ensuring that the economies continue to operate smoothly and remain competitive, and also attract new foreign investment as we go along. Especially in the UAE, what we've seen is with the introduction of the economic substance regulations last year, with the UBO legislation, AML legislation, and also the VAT law changes which were introduced this year, which has provided significant relief and confidence to the businesses that government and the businesses should look forward at the future, despite the current business challenges. Governments have also, the UAE government has recently amended the UAE investment law for mainland companies, which is now permitting 100% foreign ownership across business sectors. So this basically provides businesses with an opportunity to adapt to the new economic and fiscal realities, relook at their changes and the processes, relook at the business models, and take advantage by restructuring the operations, relooking their business models, manage the risks better, and achieving cost reduction wherever possible and cost optimization at best. This has been the main driver for us to come up with this webinar in terms of topics, in terms of what you can see in the agenda, that we want to create more awareness of businesses to address these challenges head on, and how we can take advantage of the opportunities that can be availed. Saeed, if you could kindly move on to the agenda. Yes, thank you. As you can see from the agenda, what we've compiled is we will initially start with the VAT updates, especially with respect to which is the most hot topic and most widely popular topic of reduction in VAT penalties, which has provided a huge relief to businesses, and also the certain guides which have been issued, clarifications issued by FTA in the automotive sector, and clarifications regarding adjustment of VAT rates. And also there are certain consequences in terms of the opportunity which can be availed of, I think, in terms of preparation, in terms of how you address those challenges head on. I think the best thing is strategy would be to prepare yourself for with the reduction of penalties. We could probably see increase in tax audit incidences, and also for that to ensure, we'll have to make sure that we have done sufficient health checks internally in terms of where do we stand in terms of preparedness and how well we have been organized, and if there are any errors, we can manage our risk, tax risk much better. So at the end, we will have a question Q&A session for all the participants. Every participant can log into the question on the chat, and we will take the questions at the end of the session and decide, of course, the next takeaways in terms of how we can take this initiative forward. Now, before we move on to the more technical aspects of this seminar, what we are, let's start with a polling question. What we basically, in the intention is to address some of these, the basic understanding of the tax throughput risk, what is currently faced by companies, which can have a significant impact on the company if the risks are not managed properly. Now, I request our colleague Syed Omar to launch this poll, and so that we can all get started and by answering the question in terms of selection of an answer, given certain options. I'll just read out the question for the benefit of everyone. What is the estimated VAT throughput risk being carried by our business in UAE? The VAT throughput risk basically means the total VAT which is processed through this any accounting system or the business processes and operations. So there are 4 options given to you. You could select one of them, and you'll be given 30 seconds to answer this poll, and then we will share the results. And this result is not surprising that what we see that 75% of the participants feel that the impact is close to or equal to 5%. And there are some people who feel the impact is more than 5%, 13%. And option 2 and 3 above, people have also selected. So people have selected 13%. So the correct answer is indeed option 4, which is the option 2 and 3. Basically, I will explain you why this is 75% people, despite did not, though the VAT rate in UAE is 5%, still the impact is even more than 5%. The reason why it is more than 5% or even more than 10% in certain cases is how you manage your risk in terms of total VAT, which is processed through the system, is not only the output supplies of 5%, but also the input VAT, which is being processed through the system, through your operating system, your supply chains, your AP module. And also there could be some penalties if you're not claiming and not complying, a lot of exempt supplies. So there could be significant increase. So really what is at stake is risk which is higher than 5%. So options of 2 and 3 will definitely would suggest that people should understand the importance of how you manage your tax risk across the organization. So I think it was just to get you started in terms of the thought process, in terms of what is the gravity of the situation. And even in a country like Saudi Arabia, where the VAT rate is 15%, you can well imagine that the risk is, yes, in all businesses, maybe faced with is more than 20%. So 15% in terms of the output VAT and also the impact of the input VAT as well, which is also processed. So I think that's why I think that's the main key takeaway from this poll I would like to share with you. Now here we are going to start with our session on the updates of VAT which have taken place recently, especially the VAT penalties. Now this session will be taken by Omar Saleh, who is a very, very experienced tax agent who has worked across different sectors, across different small and medium-sized businesses, and is a very experienced tax agent, and will be happy to share his knowledge and expertise, and especially the practical aspects in terms of dealing with different client situations and how those risks have been addressed by the company as well as the clients. And I hand it over to Omar Saleh and wish you all the best, and we look forward to your active participation.
Hi, good morning, everyone. My name is Omar Saleh. I'm a tax agent based in Cromac head office. And today I will be covering 2 major topics, which is basically the penalty amnesty scheme, along with the redetermination of penalties that was imposed prior to June 28th. And my second topic would be talking about the automotive sector which is specifically about the profit margin scheme along with the warranty claims. So Said, can we go to the first slide, please? So to begin with here, as we all know or read or heard before, FTA has decided to impose a penalty amnesty scheme for all the penalties that were imposed prior to June 28th. Now, everybody was under the impression that, okay, should we pay the penalty before June 28th, or should we proceed with just keeping the penalty and wait for further instructions, or what would be the right mechanism for it? Now, FTA has declared that there are 3 conditions in order for your company to benefit from the penalty amnesty scheme, which would be a 70% discount on all your penalties imposed prior to June 28th. So the 3 conditions are listed below, which is the penalty must have been imposed prior to June 28th, and the penalty was not settled prior to June 28th. So assumingly before June 28th, your company have already cleared out the penalty, then you would not be basically eligible for such a reduction for your penalties. And on top of that, you need to clear 30% of your penalties that were imposed prior to June 28th, and the deadline for that would be December 31st. Now, many companies, I mean, we've been receiving a lot of queries asking us if all penalties would be subject to such reduction, or is it some just a certain type of penalties. Now, from what we saw and from what we inquired from the FTA, literally all penalties that were imposed prior to June 28th and have not been cleared yet will be eligible for such a reduction. Said, can we move to the second slide? Yeah. Now, the second point here that we want to, I mean, give an example on is how can you view how much you have of a discount on your penalties. Now, the FTA have made everybody's lives easier. They have literally enabled in their system a way to see where, I mean, how much of your penalties are being discounted. So if you log into your FTA portal, you would basically click on top of the portal. You'll see a button that will show the penalty discount, and this page will be shown. Now, in this page, it will just literally tell you the unpaid admin penalties that was imposed before June 28th, and what would be the admin penalties reversed after June 28th. See, the reason why they mentioned this is because they had a lot of reconsideration applications pending prior to June 28th. And since they got approved after June 28th, so the amount should be showing in that field. And obviously the amount that is imposed prior to June 28th, and at the end you reach to the outstanding penalties after the reduction. So here we see that this specific company had a penalty of 2.7 million, and after the reduction it is now almost 828,000, which is almost a 70% discount. Now, in order for you to benefit really from this scheme, then you need to make sure before December 31st you actually clear all your penalties, all your VAT liabilities, along with the 30% of the penalty value, which will be mentioned as we discussed here. So can we go to the second one, Said? All right, now on top of the penalty amnesty scheme that FTA have provided, they have also amended their whole penalty structure, and they changed their whole penalty structure. And based on our experience with the clients and our market review, we have highlighted some of the important changes in the penalty regime. They have literally changed the whole structure of the penalties, but because those are the major 4 penalty changes that changed, and we kept on getting queries on them. So we have highlighted them, and we were going to cover all those queries mentioned here. So begin with, the FTA previously, I mean, if anybody was late to submit a tax registration application, which is basically within 20 business days or 30 days from the time of crossing the threshold, then previously the penalty was 20,000. But after June 28, the penalty would be 10,000. Now, we've been receiving a lot of queries on this specifically. I mean, saying that would this be retrospective or prospective? So let's give an example. For example, here one company was late to register. I mean, they crossed their threshold in probably May 2019, and they have until June 2019 to submit their registration application. However, they submitted it after June 28, 2021. So their penalty would still be applicable as 10,000 and not only 20,000. So this is also retrospective. The second most major point here is that the FTA decided to as well reduce the penalty of the deregistration application. So if you are late to deregister any specific taxpayer or your company probably, then previously the penalty would have been 10,000. At the moment, the penalty, the initial penalty would be 1,000, and it would be increasing on a monthly basis. Now, you might ask me, when should a company deregister? I mean, how late? I mean, is this as well retrospective? To be honest with you, at the moment, all applications that have their deregistration applications, if they were supposed to deregister prior to June 28 or after June 28, then the 1,000, the new penalty would be applicable and not the old penalty. However, if you were supposed to register from previous years, then you can directly just expect a 10,000 penalty, because you're already late for more than 10 months, which means already 10,000 would be imposed. Now, will the 1,000 penalty be applied only after the June 28th on a monthly basis? That's not necessarily. So if your company basically had to deregister since, let's say, April 2021, but you submitted the deregistration application today, for example, then you would be having a penalty from April until today, 1,000 monthly. So you will not be crossing the 10,000 yet. Now, the third penalty that was reduced by the FTA, and which made a big difference, to be honest, is basically the failure to settle the payable tax. Now, previously, probably maybe one of your companies as well, once you submitted a VAT return, you had a payment to be made, but unfortunately you did not make the payment on time, or some issue happened. So the penalties would be 2% on the first day following the deadline, 4% after 7 days, and 1% after 1 month, but on a daily basis. Now, this all has been changed. It will no longer be 2 for 1%. Now it will just be 2% on the 1 day after the deadline, and 4% on a monthly basis. So that's a drastic reduction in the late payment penalty. Now, when will the penalty be due? A lot of people have been asking us, if I submit a voluntary disclosure, if I had a tax assessment, would the late payment penalties be considered from the return point of view or from the date of submitting the voluntary disclosure? Now, previously, if you submit a VD, you will be getting the late payment penalties from the deadline of the return. However, now this all has been changed. The VDs have their own deadline, and the tax assessments has their own deadline. So yeah, we'll be covering the VDs now. Now, the submission of the voluntary disclosure, previously, if you submit any voluntary disclosure, you had to basically correct one of your VAT returns, and you had to pay a specific amount to the FTA. Then you will be incurring the late payment along with the voluntary disclosure percentage-based payment. Now, this has been changed. This is no longer there. if you are notified by a tax audit or you are having a tax audit, this will not be it will not be related to the submission of the voluntary disclosure. However, if you submit a VD, you will be getting 5% penalty of the difference value if you submitted within 1 year of the return date. If you submit it within the second year of the return date, then you'll be having a 10%, and then 20% within the third year, and 40% after the fourth year. But the good news here is that the voluntary disclosure penalty will not be having the late payment penalty, because if you submit a VD today and it's a payable voluntary disclosure, then it will be automatically approved by the FTA. So you no longer need to wait for it to be approved. You no longer need to ask if I need to make any payment now or wait for it to be approved. So if it's a payable VD, it's directly approved, and you have 20 business days to make the payment. Now, 20 business days from the date of submission of the VD, which means if the return was since 2018 and your VD had to pay to the FTA, I don't know, maybe some 50,000 AED, then you wouldn't need to worry about the late payment penalty, because you have 20 business days to make the payment after the submission of the VD. Said, can we move on? Now, the second topic, to be honest, that we want to go through here is the automotive sector. Now, in the automotive sector, there are a lot of ambiguities that we have seen from our clients, and we have highlighted the two major points, which is basically the profit margin scheme and the warranties, basically. The warranties that are basically provided by dealerships, manufacturers, sometimes just normal garages. So we're gonna start with here the profit margin scheme. Now, what is a profit margin scheme? It is a mechanism provided by the Federal Tax Authority that enables you to apply the VAT on the profit generated from your taxable supplies. So if you purchase any specific good, for example, for 1,000 dirham and you sell it for 1,500, then the FTA enables you to apply the VAT on the profit rather than on the whole value of the supply. However, FTA have mentioned or confirmed 6 conditions that are required to be there in order for your company to be eligible to apply the profit margin scheme. Now, condition 1 basically speaks about basically who you purchase the car from. So if you want to apply the profit margin scheme, then on your automotive vehicle, then the car must have been purchased from a dealer who is a non-taxable person, which means who is not registered or does not have a TRN with FTA, and or basically a taxable person who charged you the VAT based on a profit margin scheme. So you cannot apply the profit margin scheme if you are purchasing the car from somebody who has a TRN and who charge you VAT and you claim the input VAT on it. Now, to move on to the second condition, and this is quite interesting because this could be an alternative to the first condition that we mentioned, because if the vehicle was purchased from a VAT registered supplier and the input tax was not recovered according to Article 53 of the executive regulation that mentions the blocked input tax, then you would still be able to apply the profit margin scheme. So if basically you have purchased the vehicle from a taxable person who has a TRN and he charged you VAT on it, but you have not claimed the input VAT based on Article 53 blocked, then at a later point when you want to supply such a vehicle, then you are able to apply the profit margin scheme. Now, moving on to our third condition here, which is that basically the vehicle must have been subject to VAT before. Now, everybody might be thinking, how can I make sure if the vehicle was, purchased even locally or imported, or how can we just make sure of all of this? Now, usually when you are going to buy, if your company is into buying and selling vehicles, then you are going to be buying, many instances you will face where you will buy those vehicles from individuals. Now, those individuals might not be registered and having their own TRN. So basically, every motor dealer, they need to keep the required records to prove that the car was subject to VAT previously. So you need to ask your customer, basically, or your seller, supplier, for their purchase invoices, which you can prove that it was subject to VAT before. Now, in case of vehicles, again, you can also do it based on the year of the or the model of the car, or you can do it based on the insurance documents. If the vehicle was, after 2018, then most probably it have been subject to VAT before. Now, if we move on to our fifth condition, if we move on to our fourth condition here, is that you need to be issuing a compliant tax invoice. Now, see, to issue a compliant tax invoice, you need to mention to your supplier, which is an individual probably, this sale with no VAT. However, it was subject to VAT. So there are specific requirements for this specific tax invoice to be compliant. Now, on top of that, your tax invoice, when you sell such a vehicle, cannot include the VAT amount. However, it needs to include a sentence that mentions that your supply is subject to the profit margin scheme. So if your invoice mentioned the VAT amount, then you are not able to apply any profit margin scheme. Now, moving forward to the fifth condition here, notifying FTA. If you remember, while submitting your VAT returns, or probably at the time of registration, there was a checkbox that you need to opt, mentioning that you have applied the profit margin scheme in this period, and you need to notify the FTA that you started applying the profit margin scheme, so that they will enable your system to submit the VAT return, even though the VAT value will not be tallying with your taxable supplies. Now, the sixth condition here, which talks about the supporting documents. Now, most important thing about taxation in general is the supporting documents. Without any supporting document, you cannot proceed with any supply, whether you are using profit margin scheme, or whether you are importing or exporting. Now, some of the documents that we need to be mentioning, say, if we can move to the next slide, some of the documents that you need to be mentioning is maintaining, is the stock book that shows all the details of goods purchased and sold under the profit margin scheme, which we just mentioned previously. Now, that when you are purchasing from individuals, you need to make sure that those vehicles or cars have their own invoices and their own supporting documents. And on top of that, you need to maintain the purchase invoices showing the details of the goods purchased under the profit margin scheme. Now, if you bought the car from any other taxable person who charged you the VAT based on a profit margin scheme, then you need to show those invoices or maintain those invoices that shows that your supplier sold you this car based on a profit margin scheme. Now, the third most important one is basically, if you are purchasing from an individual who is not a registrant, and he's just a normal individual who has no TRN, then most probably he will not be providing you with any invoice. So you need to issue this invoice on behalf of your customer, that will basically mention the name, address, and the TRN of your company, the car, and the date of the purchase, the details of the product or the vehicle that is purchased, and how much you are paying this individual. And on top of that, the most important thing is the signature or the approval of the person selling you the vehicle. Now, if we give an example here, so you have a company that provided a car to one of their directors for marketing reasons, which means basically the input VAT was not recovered because since it is provided to the one of the directors, then it is considered as a private use, and the input VAT was not recovered due to the blocked input tax article. Now, at the time the director provided back the specific vehicle to the company, the dealer or the company can apply the profit margin scheme, even though the car was purchased from a VAT registered person who basically applied VAT not on the profit margin scheme, but on the full value. And the reason for that is, as we mentioned in the second condition, which can act as an alternative condition, the company or the car dealer did not claim any input VAT, which enables him to provide to sell this car based on the profit margin scheme. Now, moving forward here, moving forward, warranties. A lot of times you might be purchasing vehicles and they provide you with a warranty on the car within the value of the car itself. So in that case, this is confirmed to be a single composite supply, which means you can recover the whole VAT value even after the customer brings back the car for any warranty damages, for any defaults that are covered under the warranty. Now, the other type of warranty provided is at the time of, after selling the car, or probably before the expiry of the warranty. A lot of times the dealerships might be offering an extension of the warranty for an additional value that you need to be paying. Now, that amount again should be taxable at 5%, will not be considered as a single composite supply included in the initial warranty, and the dealer or the garage or the seller basically can recover such input VAT and on this warranty coverage, and the actual repairs charged against the warranty will not be taxable again. So if I bring back my car to the dealer and the car is under warranty, whatever cost they will be incurring, they should not be charging me VAT on it. Say the next one, please. Now, reimbursement of warranty repair costs. Now, if your company is into buying and selling vehicles, then this might be a little bit interesting, because when you are, when you are providing a warranty here in UAE, if you are providing the warranty to any customer, then most probably the warranty will be provided by the manufacturer himself. So your company might just be acting as a middleman. Now, I might be bringing back my car to the dealership. The dealership will be fixing my car, which is under warranty, but such companies cannot be bearing the cost because the warranty is provided by the manufacturer directly, which is located outside UAE. So if he's located outside UAE, then the dealer in UAE would be reimbursing such costs from the manufacturer, which is outside UAE. Now, at the time of reimbursing of those values, we have received a lot of queries on this specific topic, because at the time of reimbursing those values, this would be taxable under 5% because it is relating to a good located in UAE. Now, a lot of people or consultants might disagree with this point, that no, this can be considered as a reimbursement subject to an export of service. But in this case, this cannot be treated as an export of service because the warranty is provided to a product or a car that is located in UAE. So in this case, any reimbursement from the dealer in UAE that is reimbursing from a foreign company, then that would still be taxable and they would need to charge 5% on it. Now, moving forward to my colleague, Dishant, who is a very experienced deputy tax manager, and he is going to go through some few of the points with you, such as the tax audits and the VAT health checks. Dishant, you can go ahead. Thank you, everybody.
Good morning, everyone. My name is Dishant Chadda. Thank you, Omar, for such an insightful practical scenarios on the VAT penalties and discussing the important points from guide issued on the automotive sector. I would like to thank you all once again for taking all the time today to join the webinar. Before starting the discussion on the FTA tax audit and the VAT health check, I would like to touch upon an update on the adjustment of bad debts in the next slide. So in the next slide, the Federal Tax Authority has published a VAT public clarification on adjustment on the account of bad debt relief. In this clarification, it was clarified that the conditions which must be met in order to benefit from the bad debt relief scheme, where a supplier who does not receive payment from a customer may, under certain circumstances, adjust the output VAT on the bad debt. The 4 requirements for bad debt relief already mentioned in the law are: first, VAT on the supply should have been charged and accounted for. Second, the consideration for the supply should have been written off in full or in part. Third, more than 6 months should have been passed from the date of supply. And last, the supplier should have notified the customer of the amount to be written off. In this document, it has been clarified that the bad debt relief can only be taken to the extent of the consideration written off in the supplier's accounts, and that FTA expects the supplier to engage with the customer during those 6-month period to recover that debt. Further, the FTA expects the notification to the customer to include at minimum the invoice number, the date of the tax of invoice which has not been paid, and the amount of the consideration to be written off. The notification may be provided via letter, email, post, or any other similar kind of communication methods. The public clarification also states that obtaining the acknowledgement from the customer is not necessary before making the adjustment. Now, I understand that this kind of issue has been faced by many of our clients because we have been getting a lot of queries from our clients. So we should be happy to discuss the same at the end of the session. You can provide your questions in the question box and we can take it forward. In the next slide, I will discuss about the VAT tax audit. Since it is a high time that the business in UAE must prepare themselves for the tax audits to be conducted by the FTA, as it has been more than 3.5 years since the VAT has been implemented in UAE. The provisions of the federal law on taxation have mandated that Federal Tax Authority has the legal right to perform a tax audit on any person to determine their compliance with the provisions of the relevant laws. Omar, can we go to the next slide? So, other than the legal right to do the tax audit, the tax auditor also has a right to obtain or seize original records, make copies of the original, or take samples of the stock, equipment, or other assets from the place where the taxable person carries on his business or are in his possession. The tax audit can also be completed either at the office of the authority, the place of the taxable person where he carries out his business, or the place where he stores his goods or keeps his records. And also it is important to note that the failure of the person conducting business to facilitate the work of the tax auditor may lead to a penalty of 20,000 dirhams. So it is very important that whenever the tax auditors come, you have to comply with them and you have to provide with all the documentation. You'll have to provide the access to your office whenever they come to your office. So in the next slide, we will have a quick poll question just to understand if our audience is aware of the tax audit procedure or not. Can we have the poll question? So this is what is the period of time a premises may be closed by the FTA while carrying out the tax audit. We have four options in this. I would request everyone to select one option and then we can discuss once we get the results. Just waiting for a few more seconds to get the answers. So as we can see, a lot of people think that it is 24 hours, 42%, and then second is 72 hours, 33%. So the right answer here is 72 hours. And also there could be an option to the FTA authority that they can extend it by another 72 hours with obviously prior approval from the public prosecutor. So in this case, the FTA authority can only close the premises only in two scenarios, where there is a case of tax evasion or there is a hindrance to do the tax audit. So in the next slide, Uma, can we go to the next slide? Thank you. So now we shall look into the factors which the FTA might consider while selecting the taxpayers for the tax audit. So these are the few important factors which might be triggering for the tax audit. So such as if you do not reply to the FTA queries on time, how large or complex the business is, if you apply for a deregistration, in case of refunds, instances of incorrect, late or non-filing of VAT returns, and filing of frequent voluntary disclosures. So this is just the possible factors that may trigger for the tax audits. Other than that, there could be more options also to FTA. They can be notified by some person, by some public also to conduct an FTA audit of someone. So in the next slide, so basically this is the records that are required to be maintained as per the UAE VAT law, and which the FTA authority will ask to the person during the tax audit. So if you look into the documentation, it is basically consisted about the output and input supplies, the input tax credit, import of goods and services, goods services not related to businesses, the exports, the adjustments. So these are the records which are required to be maintained as per the UAE VAT law in terms of the Article 78 of the decree law. I'm sure that most of the clients are maintaining these kind of records, but it is important to have a look into it in case the records are not being maintained as per the relevant law, then you should update it before the FTA authority comes to their offices for doing the audit, because it may also lead to the applicable penalties in case you are not maintaining those records. In the next slide, we will now discuss that how can we prepare for the VAT tax audit. So as mentioned earlier, that FTA only allows 5 days time to respond to their queries. They will issue you a 5 days notice that we want to conduct a tax audit at your premises or maybe at their office, or considering the pandemic times, they are also doing FTA tax audit remotely. So accordingly, taxpayers should maintain these tax records as already discussed in the previous slide. They will have to provide access to the FTA authorities during the audit to their premises. Wherever such records are being maintained, wherever the goods are being stored, you will have to provide access to the FTA authority to all those kind of places where they demand to be. And all the staff members should be present at that time. In case the person who is handling the accounts, he should be available at that time when the FTA authority comes. The original copies can also be taken, and they can also make the copies of the original documents. So in the next slide, we will discuss how we can be prepared for the VAT tax audit. So the point is now that to be ready for the VAT tax audit, it is very important to do a VAT health check, in which most of the consultants like us can help you to do a VAT health check. Since VAT health check is not only to find out the administrative and the financial deficiencies in the business, but it is also be done to be improve how a corporate entity is in compliance with the laws and regulations. With this in mind, it is an opportune time for the taxpayers to prepare themselves for the eventual tax audit to be conducted by the FTA. Now, there is a misconception that filing of VAT return is the last step of the compliance in a tax period. Since VAT is a new law, it has elapsed only 3.5 years and there is no precedent in UAE for the VAT law. So people think that this is the last step, but this is the first step towards a VAT tax audit. So businesses should review their already filed VAT returns and make sure that all the tax positions adopted by the company are correct, that they have all the supporting documents available with them. The system is capturing all the required data fields into the system, and the company is preparing reconciliation statements between VAT returns and accounting data for the upcoming VAT audit. Now, one of the best ways to prepare for this is to undertake a tax health check, to examine the key areas of tax compliance and the internal controls thereof. A high-level health check may highlight the key taxes or the compliance areas where more attention is required. These health checks enable our clients to undertake any necessary corrective action before an audit takes place. With the health checks, clients will also be better prepared to handle a tax audit, as they would have been collected the necessary documentation that was put together during the VAT health check. And then they can continue to ensure such documentation is maintained and it is readily available at the time of FTA tax audit. In the next slide, we shall now discuss some scope and the benefits of the VAT health check. So as already discussed, the VAT throughput optimization during the start of the webinar by Mr. Vivek, this is very important to understand what is the VAT throughput optimization of your organization. How much risk do you have? The second is the reconciliation of accounting records and submitted the VAT returns. So now what we have to look during our health checks, during performing the health checks for our clients, is that people are not performing the reconciliation. They are not reconciling the accounting records. They are just filing their VAT returns without performing the reconciliations, in which may lead to non-disclosure of the effective VAT liability. So it is very important to prepare those kind of reconciliations. Third is identification of errors, industry-specific issues, and the clarifications issued by the FTA on a day-to-day basis. Fourth, preparation of VAT audit files with a complete audit trail. So what do you mean by audit trail is that there should be a complete chain of the documents starting from the purchase until the sale. There's a complete trail that has to be required to be maintained. After performing the VAT health check, a consultant can also provide you the restructuring options, because many of the companies who are based out of UAE also have their subsidiaries, their parent companies and group companies outside UAE as well. So it is important to see how we can do the restructuring and we can reframe the agreements so that we are compliant with the VAT law. The next is the reviewing the documentation, including the exports, imports, and out of scope supplies. Next is reviewing the tax calculation, including the refunds. So we have seen that a lot of clients are filing refunds as well, but it is very important to file the refunds correctly, because in case those refunds are not filed correctly, the computations are not done correctly, the FTA authorities might do and check of those refunds that you have filed, and they might reject the incorrect file refunds. The next is optimizing the input tax credit with the restrictions imposed. There are certain kind of restrictions like time barred invoices, blocked items, partial claims. So it is very important to do those kind of checks before you avail those input tax credits. Last but not the least is filing the VDs to correct any identified errors. So if we perform a VAT health check, then we can get to know about what the errors are. If the amount is exceeding 10,000 or the applicable way, then we can file the VDs, or else we can correct those returns in the current quarters. With this, we have completed our agenda for the today. I would again like to thank you all for joining our webinar and taking out time from your calendar. Now, I would like to hand over to Mr. Vineet Shah, our tax and technology partner, so that he can take the Q&A session and provide his closing remarks. Over to you, Mr. Vineet.
Thank you, Dishan. Thank you, Vivek and Omar Saleh, for presenting this great session. And thanks for the participations. So hope you get some more insight about that, especially like that which explained by the Omar Saleh, debts and this last session of the VAT health check. That is very important regarding the tax audit, because as you know that FTA will give you the 5 working days to provide all the records and make sure how could you be prepared within 5 days for 3.5 year record. So this is very, very important for you to be ready for any time, and at least it is good for your organization to be ready with the all this such records of the required by the FTA. Short and sweet, as such, like we can help you anytime for any related questions. You can reach out to us as time is running out, and we need your feedback. Basically, we are planning to have a more session every month, and with the subject like the automotive sector, this time we have taken, maybe impossible in future webinar. We may have hospitality, healthcare services, and many different, because as you have attended a lot of seminar, but it is not with the particular industry and with the subject matter experts in the particular industry. So here we are planning to provide more and more seminars, possibly every month you may get, and you may get the new insight in that. Here one questions we received from the participant: why do FTA insist to send confirmation to the customer informing their debts is write-off? If so, they won't make the payment, right? I think with related to debts, I request Dishan to answer the questions. Dishan, can you address this?
Sure. Thank you, Mr. Vineet. So in this case, what we have seen is now the FTA authorities are asking the people to notify to their customers that, since they have not made the payment, and you now have to notify the customer that you will be writing it out off as a bad debt, because since you are not making the payment, it is required to be done because the FTA authority wants it to be linked, that both the accounts are properly maintained and are synced.
Perfect. Thank you, Dishan. So the purpose is of that books of the wherever you pass the entry for the bad debts in your books, at the same time it should be there into your customer accounts. That need to be assured, because when the FTA audit came, tax authority may ask you for the statement of accounts of your customer where you have done the bad debts entry. One more input from the Vivek Batra, he is here with me.
Yeah, just to add to what Dishan mentioned about the main reasons also, the implications on the customer if he's refusing to pay for whatever reasons, it also notifies that he's also required to reverse the input credit if case he has availed it in the past. So that also is a kind of notification, this is the process as defined in the law, and the businesses are free to take their own decision whether to wait immediately or reverse or ask for adjustment for bad debts within 6 months, or they could wait a little longer. But the FTA has prescribed a minimum period of 6 months. So if you can still claim a write-off up to 6 months as well, after exhausting all your avenues to recover the debt. I think that's the main point I wanted to highlight also, that the supplier also needs to make sure that in case it is being written off, as per law, he's required to reverse the input credit availed earlier on the invoices raised by the supplier. Thank you.
Perfect. Thank you, Vivek. So nice of you. That's great. So thanks for the joining us, and we always welcome our clients and as well as well-wishers. Anytime anything's related to the VAT matter, even excise, if you are looking for any queries in the excise, and as a tax agency, we are dealing with the tax authority behalf of client. So we have a full solutions with the VAT and excise. Anytime you can reach out to us, we always welcome you and look forward to another webinar in possibly in the September or October 1st week. Thank you very much. Thanks for joining everyone.
Thank you very much.
Thank you.